Look at the current performance of the world's major currencies. While the euro and the Japanese yen continue to plummet, two specific currencies have surged against the rest of the market, the US dollar and the Chinese yuan. This trend has fueled a specific narrative in the mainstream media. They claim the US and China are locked in a high-stakes trade war where China is winning, and that the rise of the yuan signals the inevitable collapse of the dollar. This perspective has generated widespread anxiety among investors. Even respected figures like Warren Buffett have issued warnings regarding the long-term stability and trajectory of the US dollar. To navigate this environment, we have to look past the political headlines. Protecting your assets requires a forensic audit of the actual plumbing that moves money through the global economy. Stewardship Finance Academy conducts this audit by tracking official ledgers and capital flows. We prioritize structural data over sensationalism to identify how wealth is truly being moved. Investors who rely on geopolitical theater rather than these structural realities risk misallocating their portfolios and suffering significant wealth erosion as the market chests. To find the true measure of a currency's global standing, we have to check the IMF's Special Drawing Rights Index, or SDR. This index determines the weight of currencies that central banks must hold in their reserves to conduct international business. This chart shows the recent SDR adjustment. The US dollar's weight grew from 41.7 to 43.3%. The renminbi share increased from 10.9 to 12.2%. As these superpowers expanded, the rest retracted. The euro, yen, and pound reserve weights dropped significantly. The renminbi is threatening weaker currencies, not the US dollar. Another common claim is that China built its own payment system, CIPS, to act as a direct replacement for the Western-led SWIFT network and end the dollar's dominance. However, the plumbing of CIPS reveals a different reality. Its major shareholders include Western giants like Citibank and HSBC, and the system relies on SWIFT's messaging infrastructure to process the vast majority of its international transactions. This scale comparison highlights the current disparity. While CIPS has hit record highs of $150 billion in daily transactions, the US-based payment systems process over $2 trillion every single day. These financial systems are functioning as compatible partners. The data suggests the US and China are strengthening their shared dominance, while the rest of the global currency market loses ground. We also need to address the claim that China is dumping its US Treasury bonds to deliberately weaken the dollar. Since 2018, China's direct holdings have indeed decreased by hundreds of billions of dollars. But look at the anomalies in the official US Treasury ledger. Tiny nations like Belgium and Luxembourg now hold amounts of US debt that represent nearly 5 times their entire annual GDP. These nations act as custodial safe deposit boxes for the world's central banks. They allow sovereign entities to keep their wealth within the dollar system while keeping their names off the public official ledgers. The timeline is telling. As China's direct holdings of US Treasuries decreased by $600 billion, Belgium's custodial holdings surged by $500 billion. The capital stayed within the dollar infrastructure. It simply changed its registered address. We see a similar pattern in the global energy market. Many predicted rising oil prices following the war would collapse China's manufacturing sector. Instead, China secured a 30% discount on redirected Russian crude oil. This access to cheap energy lowered their manufacturing costs, while European and Asian competitors struggled with record-high energy bills. This shift also benefited the United States. U.S. energy companies achieved record profits by supplying fuel to a crippled European market, effectively dictating the flow of global energy wealth. Geopolitical crises act as a mechanism that pulls capital away from the global periphery. These events consistently drive wealth directly into the US and Chinese economies, while draining the rest of the world. If the structural ledgers show that both nations are benefiting together, we have to ask why the US continues to treat the renminbi as its ultimate existential threat. The context begins in 1971, when the gold standard collapsed. Without gold to back the dollar, its value became dependent on global confidence and the perceived lack of better alternatives. This safe haven status requires a sense of global instability. For the dollar to remain the undisputed choice for investors, other regions must appear comparatively less safe or more volatile. For decades, the Soviet Union provided the necessary geopolitical friction. This perceived rivalry ensured that global capital had a reason to continually seek refuge in the United States. Today, the renminbi has stepped into this role. The threat of a rising rival is the mechanism that maintains the dollar's dominance by forcing global wealth to retreat to the ultimate safe haven. The persistent narrative of a rising China provides the pressure needed to keep the dollar system at the center of the global economy. As long as there is a threat, the world has no choice but to hold dollars. While the dollar remains the primary battleground for our investments, we must remain agile. True financial security comes from recognizing these structural shifts before they are reflected in the headlines. This agility requires a system for moving capital into assets like gold, silver, or specific equities when global trends begin to pivot. Building a real system for your financial future starts with data, not rumors. Join us inside the SFA Free Stock Investment Masterclass to see how we track these flows to protect and grow wealth. Click the link in the description to secure your spot.